Hey guys, Sierra Bailey here with Accel Commercial Real Estate. The video you're watching ties into our event in June, Accelerate. If you want to learn more about what you see today, scan the QR code on your screen or click the link in the description to get your tickets now before early bird pricing runs out. Enjoy the video.
What's the loan number when it comes to Fannie and Freddie? Meaning, so it's got to be at least a million on the loan amount for Fannie. Is Freddie a little bit lower? Can you kind of explain that a little bit?
The threshold.
The threshold. So
Yeah, absolutely. It's fun to talk about this because I think that there's a very real world scenario going on right now that's kind of important to note. So there are a bunch of different products from both agencies, but the easy way to simplify it into numbers, if we're just talking about traditional multifamily, is that there is what's called the small balance loan program, or SBL for Fannie Mae. No, I'm sorry, SBL for Freddie Mac Chapter 9 for Fannie Mae, or their small loan program. But throughout the industry, we mostly just call it SBL. And then there's the conventional loan program. So for Fannie Mae, it's 1 to 6 million is the small balance, and anything over 6 million goes to the conventional space. And then for Freddie Mac, it's 1 to 8 million, and everything over 8 million goes to the conventional space. So, I think you can, like, if you go online and you Google, and I get this phone call a lot, is that, the agencies advertise that they'll lend $750,000 for a loan amount. I think the challenge there is that by the time you add in all of the extra stuff that the agencies want to lend that low of a loan amount, it actually, I talked about being the never losing to banks. That is a situation where a bank quote outside of recourse could potentially be more attractive because there's a ton of adder that gets added and leverage gets dropped considerably. So we as a firm, we have $1 million minimum loan, and I know what I wanted to talk about, like a real world example, or something that's really relevant right now. Right now, the interest rates, of course, are climbing with the 10-year, but the difference in interest rates between Fannie Mae and Freddie Mac's small loan program is like crazy ridiculous. And normally the agencies are not this far apart. They try and, they compete with each other. So they try and, more or less they're kind of duking it out. Right now, the Fannie Mae rates are almost 65 bips in the small loan, 65 bips larger than, or wider than Freddie Mac in the small loan space. And, there's a compelling argument there that, number one, Fannie knows this, and number two, they're not doing anything about it. And so, I think it leaves the question to ask, how active does Fannie Mae want to be in the small loan space moving forward, right? Because right now it's just incredibly difficult to transact in, and they're, getting, if a deal can go Freddie Mac, they're getting crushed. And I'm not going to speak on behalf of Fannie Mae, but I don't think they're naive to that fact. Having said that, Fannie traditionally is a lot easier to transact in smaller markets. So this might have a considerable effect on small loan product inside of, tertiary and rural markets. We don't know yet. I mean, I think, we'll watch what the agencies do, or specifically Fannie, what they do over the next 6 months. But it's a really interesting dynamic going on right now because it's a very noticeable difference. But in general, the small balance program right now is more expensive than the conventional product, and it is significantly different. We are still sub-4 rates in the conventional. We're starting to get there with the 10-year, like we're really creeping up on 4 right now. But the small loan space is almost at 4.5, 4.5, 4.6. So it's, I mean, obviously the 10-year has popped, what, 70, 80 bips in the past 60 days is driven rates considerably. But, you know, it's, again, kind of going back to the fact that Fannie has this really high rate in the small balance program, and they're not trying to lower it is an interesting signal. And, you know, my hypothesis is that the $70 billion that is, I mean, evaporating could be part of a driver.
Just simple law of supply and demand in effect there, essentially.
Yeah, you know, it's interesting. I think what's crazy about interest rates, and there's a varying degree or a varying opinions on this subject on you know, what factor debt has in the market. And you know, I hear it all the time that, oh, debt doesn't drive the market, right? Like, you know, people wanting to buy, people wanting to sell. Right, exactly what you said. You know, supply and demand drives the market, and it certainly does, right? That's basic economics. It definitely does. But I think the question becomes, you know, to what effect does debt have in the market? And if you are on the side that argues that debt doesn't drive the market, then I think you have to look, you know, at the past year and where cap rates have gone, because rents have not moved that much. And there's a good argument that rents are about to move considerably because of inflation, but in the year of you know, a 1 year time frame, you could argue that rents have not moved that much. In fact, there's a considerably large number of people who aren't even paying rent. And yet properties have transacted for 50 bips less in cap rates. And so, you know, it seems coincidentally timed with the fact that rates have plummeted to their historical low points. So I think, you know, as for me, you know, there's a lot of lenders that work solely in the refinance space. I don't, because I'm a glutton for punishment in acquisitions. It's just really as these rates continue to rise, which I think it's also fair that we go ahead and say, you know, we're not even above 4 yet. So these are still really attractive rates. But as the rates continue to rise, you will see, I think, you will see cap rates start to widen, and valuations may go down a little bit. But that keeps an active market, and that's good. So I think one of the biggest fears is, oh, you know, the acquisitions market is going to dry up if rates go up anymore. Well, I mean, I guess when you do the math backwards, the only reason that the acquisitions market is selling for what it is because you know, people can hit 1.25 debt service coverage ratios when rates are 3.15%, right? So if that space still wants to stay active, then I think it will go as long as rates remain in a viable area where the disposition of assets can hit their required returns for the previous investor group. I think we have a long way to go for that to happen, because when I entered the space, rates were 5% and everybody was saying, this is crazy, right? This is so cool, this is so low, like, you know, this is great. So the kind of the delta of where people are in their life cycle for assets that should be coming online over the next, call it 2 years, should be in line with a time that had a, you know, higher interest rate than where we are today. So I do think the disposition of assets will continue, and as long as there's sellers, hopefully there's buyers.
Can I ask you to talk about two different things? One, talk about bridge loans, number one, and then the other one is, can you speak to Freddie and Fannie's recognition of what is the definition of small market? And one thing that I think some of our clients may not be aware is Freddie and Fannie don't lend on every single apartment building. It depends on where they're at, and maybe you could speak to that criteria, and so that people can plan for that, because I think there's, in my opinion, it should be the goal of most investors to be able to eventually qualify for Freddie and Fannie. But in order to do that, it's important to know that not all assets can qualify for them. So bridge loans and definition of acceptable assets for Freddie and Fannie.
Yeah, so let's talk about bridge loans first, because I think right now it's a very, very, what was it, 2018 at NMHC, which is basically this large convention of multifamily lenders, brokers, sponsors, buyers, property. If you're involved in multifamily and you want to go a network, NMHC is the place to go. And in 2018, NMHC said that 2018 was the year of the bridge. And essentially what they were talking about is that in about 2015, there was a massive explosion of construction of apartment complexes in America, and especially in urban core America. And the assets that were supposed to be coming online and coming off of bridge and going into agency debt were not coming off, because the vacancy rates were still significantly low because there was so much new product coming online, and folks were hopping apartments like the Easter Bunny. If you could get 3 months concession, you would do it, right? And it was super thematic of 2018. So there was a ton of properties that were going back onto the acquisitions market, but were going into bridge, going from bridge to bridge. And so it was called the year of the bridge. I would like to say that the past 2 months has been the past 2 months of the bridge. And I, have worked on 3 different transactions now, working on 3 different transactions right now, that because of the uptick in the 10-year treasury and where cap rates have been, in the past, call it 6 months, assets that were extremely tight on sizing have now left their sizing capability. And they have flipped from Fannie or Freddie over to bridge debt, which has been super advantageous for me, because right around the time that happened, our firm decided to bring our bridge product back online from, sort of like a pre or post-pandemic, evaluation. I think, we're back to be in the space, and our product is exceptionally attractive. I've been in a lot of competition with this product, and we're seeing, most of the deals come our way. So our bridge product for us, we are 80% purchase price plus 100% of the CapEx. Right now, our rates are, of course, everything's tied to LIBOR in this business, which I think probably today is somewhere around 10 to 13 bips. We are transacting with spreads as low as 325 to 350 over LIBOR. We're putting, a 50 bit floor on LIBOR just in case of a pop, but so, we're sub 4 rates on, upwards of 87.5 to 89% loan to full cost. And then we're IO throughout the period. It's a 1 in, 1 out fee, but we'll waive the 1 out as long as you, stick around and go agency, FHA, or HUD. And we have a minimum loan amount of $5 million, although I will say, like, economics wise, it probably doesn't make sense until $8 million. But yeah, I mean, it's a really attractive product. We can close it in 35 to 40 business days, or 35 to 40 days, probably 30 business days. So it's and I've seen a lot of that movement from agency over into bridge because of the interest rate situation that's going on right now. So you heard it here first, the 2 months of the bridge. And then so this is a big transition here, talking into your second question of the definition of small markets. It does differ a little bit between the 2 agencies. I think primarily what matters from a lender perspective, and what I think is like our great challenge, is when we have our delegation and when we don't, right? So there are a couple different things in terms of markets that can trigger just pre-review automatically. The first one is simple. This is an easy one to remember. If it's 10,000 population, 10,000 or less, then that is going to trigger pre-review, and we're going to have to go in front of the agencies. And to that respect, I think, you require a really good sponsor, right? Someone that's used to owning in those markets, someone that, has a property manager that's coming on board that's used to managing in those markets, because it's a very, cities or towns with less than 10,000 folks is a very unique demographic of people that are going to be around. So that situation can open up a little bit more of an in-depth analysis, prior to an extension of a loan application. But what the biggest driver is for the agencies and what determines the market to market is their concentration of financing inside the market, which there's not a magical number, but there is an ever evolving list that comes out every 30 days that a market can become pre-reviewed just because there is too much of a concentration or some other type of reason, right? Too many defaults or something's going on. I think, it's interesting. The reason that these small markets always seem to be pre-reviewed, these really small markets, is because it doesn't take that much exposure to hit that level, right? So if you've got, a city village with 3,000 multifamily units, and Fannie Mae is financing, 2,000 of them, then that may be something that they're concerned about, right? But it's not hard to finance 2,000 units. Whereas, maybe you're financing 100,000 units in a major MSA, and there's no problem with that because that's fine. Having said that, Manhattan is a pre-review market right now. So, it's not always the size of the market. Chicago is a pre-review market right now. And it is extremely difficult to get deals done in these markets. And I do not think that if there are bulls on New York and Chicago and some of these major MSAs, they're hiding in cages because it is, I don't think that there's a whole lot of good sentiment right now for those markets. But alternatively, when you look at markets like Nashville and Louisville, Kentucky, and the Carolinas, the Charleston, Huntsville, Alabama, Birmingham, Alabama, anecdotely, the entire state of Louisiana. but when you look at some of these areas, these markets are highly favored right now by the agencies, and we can incredibly attractive loan products for those types of areas, and they're the markets that surround them, right? Like the Clarksvilles, the Murfreesboros.
Thanks for watching this video. If you like what you see, be sure to follow our Generational Wealth Learning series. On select Thursdays, we offer cutting-edge industry information that would normally cost thousands of dollars. And the best part, our education is absolutely free. If you register through our events page, you can join us live, either in person or over Zoom. In the meantime, like this video, comment down below, and subscribe to our channel so you never miss a beat.